Good afternoon, everybody, and thank you for joining us this afternoon. I'd like to commence the webinar, which is an introduction to the CPF Real Estate Credit Fund. For those of you that don't know me, my name is Joe Christie, and I'm an Executive Director of Capital Property Funds. Just want to cover a quick disclaimer. Everybody should take some time to read that, but importantly, past performance is not a good indicator of future performance, and the distributions and investment returns depend upon the performance of the underlying investments. So what we're saying is the returns for any of our funds are not guaranteed and do depend upon a number of factors that may be beyond the control of the manager. So just to introduce the CPF Real Estate Credit Fund. So as the slide implies, the name is the CPF Real Estate Credit Fund. And the fund type, so it is a pooled real estate mortgage fund. So traditionally, CPF has offered individual lending opportunities, which are often referred to as contributory mortgage schemes. This new fund is a pooled mortgage scheme where a number of mortgages are available or offered to the investors. So they choose to invest via the fund, and the underlying security is exposure to a pool of real estate mortgages as opposed to an individual mortgage opportunity. Capital Property Funds is the fund manager of this particular fund. And we also have an independent trustee, AML Security Services Proprietary Limited, and they perform a number of roles. So their role is to enforce or ensure that the mandate of the fund is being complied with. They control all the fund assets, such as the mortgage documents, any application monies, etc. And they also appoint capital property funds under an investment management agreement, and they monitor our performance. The Real Estate Credit Fund is only available to wholesale investors, as that term is defined within the Corporations Act. And the fund will be open at the end of the month, being Monday, 30 September 2024. So we confirm that will be open for applications as at that date. The fund is targeting an investment return of 9%, net of all fees and expenses, and that rate is calculated as a margin above the official RBA cash rate, being 4.65%. Now, with the contributory mortgage fund, it offers a fixed rate of return. For example, it may offer a 10% return for a 12-month period. One of the differences with this new fund is that the rate is a variable rate, so it's not guaranteed. So if the RBA cash rate moves, then potentially the target return could also move. And like all of our funds, distributions from this fund are payable on a quarterly basis. Okay, some of the investor benefits, as I mentioned at the beginning of the presentation, this fund will provide the investors with exposure to a diversified pool of mortgage assets. The other thing too, we've had some feedback from investors where under the contributory mortgage fund that we offer, at the end of the term, money is returned to the investors. And under this particular fund, you can put money into it and it will always be invested until such time as the investor chooses to redeem the fund. So talking about redemptions, the fund does offer regular withdrawal opportunities every 6 months, actually. And additionally, investors can make regular contributions into the fund. We think the yield is quite good at 9%. I think that's an attractive income yield. And it'll offer good capital stability when compared to listed investments because the underlying assets being mortgages over property, generally they're regarded as capital stable. So coming down to some of the investment terms, so the minimum investment in the fund is $50,000, and any additional application has a minimal amount of $5,000. We don't really have a strict investment term, but we are suggesting that this fund should be looked at as a medium to longer term investment. So we're saying the minimum investment term really should be 12 months, although we do offer redemption periods every 6 months. And they are offered on the 15th of March and the 15th of September each calendar year. They're not guaranteed withdrawals, and they are subject to certain terms and conditions which are described in further detail in the information memorandum. Coming to fees and charges, so the CPF, as the manager of the fund, is entitled to a fee of up to 2% per annum of the fund's gross assets. Typically, on our contributory mortgage fund, we charge a management fee of between 0.5 and 0.75%. So we intend to maintain a similar style of fee for the pooled fund, although the Constitution does allow for a fee that is larger than 0.5 to 0.75. The other thing too is that this pooled fund may at times invest into loans that are offered by our other fund, being the CPF Property Debt Fund. Where we do that, we can't charge any management fees for funds that have been placed into a fund that is related to capital property funds. And for further details on the fees, we refer people to the disclosure section within the information memorandum, and which will be available for download from our website at the end of the month. Some key investment strategies for the fund. What we always say within capital property funds is that it's easy to lend money. The hard bit is getting repaid. So we're very focused on what's called the exit strategy, or our repayment method. And we also have to be very comfortable that if we were not able to be repaid, that we were happy to own the underlying property. And if we aren't able to answer that question in the positive, then we won't generally lend money against that particular asset. And the other thing too is that we are very focused on lending to high quality and experienced developers, ideally with a successful track record or somebody that we have known for a long period of time. The reason we say that is good quality borrowers tend then also to have good quality assets. And also too, our lending philosophy is as a partnership with our borrowers. So we believe that the most risk is when you lend to somebody for the first time. So we want to partner with our borrowers, and provided they perform in accordance with our standards, we want them to become repeat customers. So it's not a master-servant relationship with our borrowers, it's a partnership, and we are ideally looking for repeat borrowers. And co-investment, so the manager we participate in every opportunity that we offer to our investors, and we will also be co-investing in this particular fund. Our core lending expertise, so the regions that we particularly like are metropolitan Sydney, and I use the term the gigantic golden triangle. So basically from Noosa down to the Gold Coast and west to Toowoomba, we're very comfortable lending into those two areas. We're not precluded from lending outside those areas, but most of our loans tend to be in that area. The reason being is that once you start a relationship with good quality borrowers in these regions, those particular borrowers tend to have other projects within the region, and they introduce us to other industry colleagues that also work within those areas. So we like the areas and we like the dynamics of those areas, and we've just got a particular depth of knowledge in those particular regions. Yeah, as I said before, so primarily in those regions, but certainly we're not restricted to those regions. The type of loans that will be coming into this fund are residual stock loans. for those of you that aren't familiar, we divide development risk into three categories. So you've got planning risk. So you have an idea of wanting to do something and you need to get approval. So that's what's called planning risk. Then once you've got your approval, you need to execute on those approvals. We typically call that construction risk. And once the construction has been completed and reached what's called practical completion, you'll have marketing risk. So typically with a residual stock loan, you've really only got marketing risk. So it's been approved, it's been constructed, and this is the residual stock that needs to be sold down. And often a developer doesn't want to sell the stock down with time pressure. They want to take time to market and maximise the potential gross selling price of the completed stock. So we will offer what's called a residual stock loan. We like them because you don't have planning risk, you don't have construction risk, you really just have marketing risk. So in some ways, provided that it's a good quality product and there is a market for the product, they can be lower risk than other types of lending opportunities. Construction and development loans, many of you may have invested in some of those. So that is where they have a planning approval. So typically with capital property funds, we don't take on what's called planning risk. So every opportunity that we lend on will have all the approvals in place. So we were looking at construction risk and marketing risks. So we do like construction. I'll talk about residential and I'll talk about commercial/industrial projects. At the moment, the construction loans that we are funding in the residential space are what I call non-built form construction loans. So that would be a land subdivision that involves civil contracting, putting in curbs, gutters, roads, sewer, electricity, but no what I call built form construction. And the reason being at the moment is that those particular types of projects, they're what's called their feasibility analysis or their profitability are quite difficult. The reason being, primarily it's due to inflation around construction costs in residential, and residential construction tends to be quite intricate. So where we are doing construction and development loans in the residential area, it'll primarily be for a land subdivision where it doesn't involve much built form construction. That may change as the market condition changes. However, if we're looking at commercial projects and/or industrial projects, we are at the moment funding built form construction in both commercial and industrial. And if we look at the profitability of those particular projects, at the moment you can build an industrial project, typically it's what's called tilt slab precast concrete. You're building it at say $2,100 per square metre, and you can sell the finished product at between $5,000 to $5,500 per square metre. So it's relatively profitable construction, and it's not as intricate as residential. It's quite more formulaic. So it's usually a slab of concrete that's been precast, and then it gets drilled into stabilized into a cement slab and then reinforced with stainless steel roofing, which provides structural integrity. So they're fairly simplistic. So we are doing commercial and industrial at the moment. And I've said here, we also will do stabilized income producing assets, particularly commercial and industrial assets. That's where, again, probably not too dissimilar to a residual stock loan, except you'd have an asset that has been completed, and often it may have a rent agreement over the top of it that's providing income support as well. We have one at the moment in Paddington in Brisbane where they are building a childcare centre. Once that childcare centre has reached what's called practical completion, and they have their occupancy certificate, the lease will become activated and it'll become income producing. Realistically, with that particular project, they would then go and seek typical bank debt funding on cheaper terms. So in Globo Land, still talking about loan type. So in Globo Land is another a strange word, but it just means a land mass that would have, typically for us, must have appropriate zoning and approval. So they would have approval for a land subdivision. So we're very happy to fund in Globo land waiting to be developed, provided it's got all the planning approvals. Residential land subdivision. So that is where Englobo land has been carved off to do a residential subdivision. And again, at this stage, it would only be the land. It wouldn't involve much what's called built form construction. And then where we are doing built form construction, it'd be in industrial and commercial. And we also, as mentioned before, would fund commercial buildings that have an income producing lease over the top of them. So the loan range, and this is quite important, typically the loans will range between $5 to $30 million. Internally, we call them doable projects. So it's not a $300 million coal loading facility, in the Newcastle port or something like that. These are relatively simple projects. If they get into trouble, typically we have what's called a tripartite agreement. So we are a party to every construction contract, and there are three parties, being the borrower, the lender, ourselves, and the builder or civil contractor. If either the civil contractor / builder or the borrower fails to perform, we have step-in rights, and we can generally complete those projects. So we have internally what they call development management expertise. So we look at the buildability of a project and whether we're comfortable stepping in should the project get into trouble. And typically, that $5 to $30 million project is what we call, again, a doable deal. And the loan to valuation ratio, the fund will primarily be dominated by first mortgage security. That's where we will lend up to 65 cents in the dollar for a particular project. On occasion, the fund may lend higher than 65 cents in the dollar. We will go to 75 cents in the dollar, but it would be structured as a first mortgage to 65 and then a second mortgage for the balance being up to 75. And we will only do a second mortgage where we control the first mortgage. So that's typically how the fund is structured. There may be the odd occasion where we would do purely a second mortgage, but to date we have never done a second mortgage where we don't control the first mortgage. And at the moment, for a first mortgage, you're getting around about 10 to 10.5% return, and for a second mortgage, you may get up to 18% return for that additional 10%, 10 cents in the dollar. So talking about our lending guidelines, so the mortgage security would be first and second ranking mortgages. And then we do take additional security where possible. So that includes personal and company guarantees, general security agreements. And as mentioned in the prior slide, every construction contract will be a tripartite agreement where we examine the construction contract and we are a party to it. And also we require the assignment of the license to use the intellectual property by the holder of granted by the holder of the copyright to use all the plans, drawings, etc. That's particularly important if you do need to come in and take control. You want to have all the architectural drawings, etc. To complete the project. And also we have the right to use some of the material for marketing ourselves, which is not as important for security. The other thing independent valuation. So we like to have an independent valuation by a qualified valuer that's recognised by CPF, and typically they're no older than 3 months from the date of loan application. So they're generally required to be up-to-date valuations. So look, that was all I really wanted to cover. There were a few people that may have come in late into the seminar, but the fund will be opening on Monday, the 30th of September. The minimum application is $50,000 and it'll take increments of $5,000 above that. Your money, the benefit is that your funds are invested all the time until such time as you choose to redeem from the fund. And the fund does offer biannual redemptions in March and September. And we're targeting at the moment a return of 9% net of all fees. The only variable may be if official cash rates move, then that will be a variable rate as opposed to our contributory mortgage fund, which is a fixed rate return. So thank you very much, and I'm happy to take any questions if anybody wanted to pose any questions. You can do that, sorry, on the chat above your above your screen, where you have the ability to ask a question. And somebody had their hand up there. Okay. Look, we don't seem to have any questions, but thank you very much for your time, everybody. Keep an eye out on the website. You've got my contact details, and you've also got our general info@capitalpropertyfunds.com.au. And if you are interested to register for the new fund, feel free to send an email, and we'll make sure that you get an application form and the new offer document before the end of the month. So thank you very much for your time, everybody. Oh, okay. Sorry, I do have a question here. Yes, someone's asked a question about whether the fund will be invested in existing projects. That is true. So, provided those existing projects comply with the term of the terms and the mandate of the fund, we will invest in that. So we can co-invest into other debt funds offered by CPF. And I had a question there regarding the term, but that question might have dropped away. Let me just see if I can find that question again. Look, someone's asked a question. Look, it potentially could invest into something like we do have a property fund called Coronation Drive. I don't think it would invest into that fund because the rate of return that we require would be too much for the fund to bear. So I'm just seeing. I saw another question there. I'm in here. Okay. The minimum term. There is no minimum term. Somebody's asked a question, but we do offer 6 monthly redemptions. Yeah. So, but if there aren't any other questions, thank you again for your time, and feel free to reach out if you'd like a copy of our information memorandum when it becomes available.